Yeah, I mean, monetary policy can only do so much. We've seen that in the US. Even while we've had quantitative easing now for a long time, 3 years, and you've had an improvement in economic growth, but ultimately, it's still subpar. In Japan, we've had it for over a year now, and we're still bouncing around very low growth levels. And in Europe, it's now essentially started. To really simplify quantitative easing for the economy, it's drive interest rates to zero, force people out of cash into investments, asset prices go up, and at some point, asset prices mean that some people sell their shares or they crystallise their share options. At some point, they'll add a wing to their house and eventually employ a carpenter. And that's really the simplified way of looking at it. And the reality is it's a very blunt tool. It massively favours people with assets, so rich people over poor people. It creates income inequality, and so it has to be done alongside fiscal policy and also alongside microeconomic reform, and that's where Europe and Japan both don't have what the US has in terms of being able to make their economy more flexible. Yeah, so to be clear, the Eurozone wants to stay together, and no one wants to be the person who stood over the Eurozone falling apart. And so the reason why quantitative easing's come is they probably looked through this deflation. They looked at Greek elections and upcoming Spanish elections, decided they've really got to do more to help people on the ground. You've got 20% unemployment in a lot of these countries. So we are getting more stimulus in Europe. It will have some effect at the margin, without doubt, potentially a reasonably significant effect, at least on equity markets, with a lesser effect on the economy. But this is all because ultimately democracy rules, and if you don't make things better, then you won't be in power any longer. And eventually someone will go democracy in the way to leave the euro altogether. So they really do feel the urgency. Yeah, definitely. I mean, Europe has been a massive laggard in global markets. Japan has been a laggard for nearly 20 years. And so these are big changes in the economy and big changes in the structure of interest rates, the risk-free rate. And so when you're looking at rates that are literally well below 1% and well below 0.5% across most European countries, versus companies that are giving you dividend yields of 4% and some earnings growth, I mean, it's obvious why their share prices are going up. And it's the same in Japan, and it was the same in the US for 3 years. So this is a good opportunity to invest, or whatever, regardless of what your views are. Your alternatives are cash, or very low yielding bonds, or very expensive properties. So it does make a good environment for equity investing.